This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Monday morning, we are starting a fresh new week. We are coming to you, as always, from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, good morning.
Hi, good morning. Last week was tough for our markets. Let's hope this one's better.
But Friday was not as...
Friday was...
I mean, you know, looking at Thursday's US market change, one would have thought that Friday is going to be really bad. But Friday morning, you had that big announcement, right?
Yeah.
The inclusion in global bond indices. And I think that kind of swung the sentiment a little bit.
What about, are you guys ready for longer trading hours?
Oh, the evening one.
Yeah.
But I think that's going to be okay, right? I mean, it's screen trading. I mean, so which means everything is screen trading actually, but it's going to be...
As long as we don't have to report on it, then it's fine.
Reema just...
Well, don't count on it because, I mean, you know, something happens, US, I mean, you know, the reaction here. So, but we'll see. As
Prashant to the rescue.
All right, with enough help from you guys. Okay, well, let's just kick off with, you know, how things are looking as we begin another trading session. So you got... you know, as I said, Friday could have been a lot worse. It was bad, but it was not as bad as it would have been had it not been for the announcement which came through, which I'll get to in just a bit. I mean, I think enough has been written and enough has been spoken about it, but it is a significant positive. The Nifty, to just kind of set the context, ended below an important level, the 20-day moving average, which was 19,700. So we ended under it, just under it, not by very much, but the close was below. Global cues, I mean, I'll come back to the levels in a bit, are muted. I mean, they are cautious, right? The S&P is down about 0.23%. That was on Friday. The dollar index moved up a little bit, almost, you know, on the other side of 105.5. Oil is steady, pretty, holding at about $94 a barrel. And oil is the big one, right? It's up 30% from June. So that's a very significant sort of, you know, change in terms of large importers like India and the terms of trade. In the US this week, there is another potential risk. So, you know, it comes up every now and then. It's come up again, which is that without a deal between the Republicans and the Democrats, US government will shut down on the 30th of September, literally shut down, because they can't spend on pretty much anything beyond the 30th, which is on this Friday. So I think that's the big one, which is, again, kind of center stage. Usually it gets done. No reason to expect it will not get done this time around as well. But, you know, going into it around that time, it does cause a bit of volatility, does cause a little bit of nervousness, etc. So we'll watch. The other thing is, I mean, in the US context, is that, you know, the auto strike, the union workers' auto strike on Friday, that got sort of expanded to about 40-odd facilities across, you know, large OEMs, large automakers in the US. So it's more of a economic sentiment, etc., negative. It's not a positive. I mean, the degree of negative, etc., can be argued. India's inclusion in the global bond index is a big positive, and don't take away from that. It's positive on so many fronts. You know, you come back and you look at oil, which is high, you look at, you know, dollar, which is higher, but you got this positive on the other side. And it's a one-stock $30 billion adjustment and then an annual inflow of about $15–18 billion. Of course, you know, it only gets implemented from the middle of next year, but there could be, you know, FPIs, etc., which perhaps will sort of preempt that with positioning now and till the time of implementation. So this is a big positive, and it will continue to play out over a period of time. So I think one has to keep that in mind now, especially when you look at what's happening with the dollar, oil, etc. Coming back to the sort of levels here, you got the Nifty pivot, which is, I think, still around 19,700, which is the 20-day moving average. Let's see if the market stays around this particular level or there is significant divergence. On the downside, it's important that 19,605 does not break, which is the 61.8% retracement of the entire rise from the 31st of August low to the 15th of September high. So, you know, 61.8 is the big golden retracement, and that's, I think, that needs to be held on to if the market's got any sort of chance that, you know, this is it. This is the correction that we are seeing, and we kind of either spend some more time here or the market starts to move up. Bank Nifty, it's interesting. I mean, the Nifty did more on the downside. The Bank Nifty actually ended absolutely flat. So The 61.8% is 44,778. We ended below it intraday, but we ended above it. Sorry, we kind of came up above it, but could not close above it. So again, that becomes the first level as we begin another sort of trading session, if that comes into play again. On the downside, the next downside level to watch is 44,370, which is not very far away either, less than 1% or so away compared to where we left off on Friday. I think the GIFT Nifty is indicating a slightly higher start. I would say watch the open, don't kind of rush in or anything of that sort. More than what's happening here in India, what's happening in the US for the first time in 2023 is looking like things aren't going all that well. So you don't want to get caught in, what perhaps would be a global kind of a pullback. And it's unlikely if the US starts to correct a little bit, meaningfully, etc., things here will look up and up. Most likely it'll be sideways, if not lower. And that's the reason why I'm saying no harm in waiting on the sidelines and letting the market tell you what it wants to do next. It's a flattish kind of a start, 15 odd points lower as per the GIFT Nifty. Rima.
Well, on the US markets, the S&P 500 is now down 4.2% for the month of September. The Nasdaq is lower by 6%, headed for its biggest monthly loss since December. The cut on the Dow is a little more muted at 2.2%. So just to add to that data point about the US markets turning a bit tumultuous and a bit iffy. In that context, the Indian markets is still outperforming. Yes, last week we have 4 consecutive sessions wherein the markets ended in the red, but month to date, the Indian markets are still up 2.5%. So we've clocked in a pretty good outperformance, but investors are now so deep in the money when it comes to the Indian equity markets. FIs are pulling out. The FPI sell figure in the month of September has crossed 10,000 crore rupees, according to the latest data from NSDL. So that's something that the street, not 10 crore, it's 10,000 crore. That's the FPI selling that we've seen in the month of September. The big Q is going to be the September expiry, and that's going to be on Thursday. And also keep your eye on the IPO market. Today, you've got 2 big IPOs opening up. One is JSW Infra, and the other one is Updater Services. And we'll talk more about both of them.
Well, last week it was, in cricketing parlance, it was like you had Sachin, Sehwag as well as Saurav. When they don't perform, then it became tough for the Indian cricket team, right? So last week you had HDFC Bank, Reliance Industries and ICICI Bank. They accounted for close to 70% of Nifty's fall. And by the way, it was the worst week that we had in the last 7 months or so. So that explains why last week was a little bit of a weak party. But it appears, the bulls, they partied very, very hard. And now there are some signs of everyone getting a little bit sober, taking cognizance of what's going on in terms of the global market, the headwinds that are facing us as well, higher crude prices. The Fed could keep rates higher for longer. And also you have global cues on the whole, they're a little bit subdued. The Nifty, well, it's showing some sign of weakness, and it closed below the 20 DMA even on Friday. And on a day-to-day basis, you're seeing the Nifty, it appears it's a little bit afraid of heights, because every day it's come off close to around 150 points from the high point of the day, telling you that at higher levels we're seeing an intraday pullback, but that couldn't sustain. Even in Friday's trading session, it appears we're heading to around the 19,800 odd mark, but then we did see some selling from that mark. The problem pocket has to be HDFC Bank. Remember, that's been one of the big outperformers in the last few years. But, just in the recent parts, 18, 24 months odd, HDFC Bank has been a bit of an underperformer. That's the chart on Friday. Once HDFC Bank loses its way, the Nifty loses its way. Not just on Friday, even for the week. HDFC Bank was down close to around 7%. The Nifty as well did see selling pressure. It was down close to around 1.5%. It was down actually close to around 2%. That's a 7-day chart. That's why that's telling you the picture. So HDFC Bank, that's a bit of a problem pocket. You'll want it to bounce off these levels because it's breaking down even technically right now. Fundamentally, though, part of the street believes that it's very, very delicious. So I'll be watching on HDFC Bank from here on. Can it hold on to this 1,500 rupee odd mark? What do the FIs do? They added shorts. They added close to 9,000 short contracts, though they continue to remain net long with 53% of their positions on the long side, 47% on the short side. But just take a look at the long positioning. A week or so ago, you had more than 60,000 net long contracts. That number has come down by a fifth. It's come down to around 12,000 contracts odd. What's that telling you? There is unwinding of long positions and there is some short build up as well. I'll want some more shorts to get into the system. You get some bit of good news and then those shorts could be forced to cover out. This market has been devoid of any kind of short positioning and now there are shorts in the system. I wouldn't read that as such a bad thing. The problem is they're writing calls as well. So they don't expect the Nifty to go past the 19,900 odd mark, which brings us to the options data as well as the data points. Writing was seen at around 19,800 call in Friday's trading session. The premium there was roughly around 50 rupees odd. So 19,850 to 19,900, crucial levels on the upside, resistance levels on the downside. The 50 DMA is around that 19,600 mark. So that's the important point. A bit of a range between 19,600 to around 19,850. For starters, the gift nifty suggesting some bit of green. HDFC Bank, that's the stock that you should be focusing on. Can it give up its underperformance? Well, time will tell.
All right. So that's been the big one, the big underperformer, and we'll keep an eye on that one. All right. What we'll do is we'll have just look at the SGX, the gift nifty. Sorry, it'll come up on your screen. I think we'll have about a 13-odd point lower start according to the gift nifty. 19,695 is where we're at. Well, let's just get you a couple of calls. Rhythm Desai of Morgan Stanley on equities weighs in. He says the opening up of the sovereign bond market and resultant inflows are likely to be beneficial for the Indian equity returns due to the positive impact on growth, likely softening implication on interest rates and accentuate the case for India's return correlations to decline. He says in terms of sector preferences, they like financials and consumer discretionary and would avoid global materials.
Venugopal Gare of Bernstein says India is heading and has already entered a new upcycle which will last for several years. He says those like us who've seen previous cycles as an equity market participant would have seen the disbelief in a cycle all through the period as every year appeared to be a peak, that the time for earnings for markets. He says any corrections which is characterized as the end of the cycle, he says the reality is that all signs suggest that we are in the next phase and a similar disbelief on a cycle remains. He adds until they see a case arguing against the room for an upcycle, they would prefer remaining as buyers on any correction in the equity market. He also adds financials, capex-linked stories will lead the cycle, followed by a broader recovery in consumption.
Okay, some money market views now. B. Prasanna of ICICI Bank says that hawkish guidance by FOMC and status quo by the Bank of England and Bank of Japan kept dollars strong against G3 currencies. He says rupee strengthened marginally on the news of bond inclusion and global bond index. However, the move mostly reversed as rising crude prices and US yields remain headwinds for local currency. He says the rupee is expected to remain under pressure amid strong dollar environment and trade within the $82.7 to $83.3 mark, with the RBI smoothing out volatility.
On the bonds, B. Prasanna says even as US Treasury yields attain new highs, local bonds remain supported owing to the announcements of inclusion of Indian bonds in the JP Morgan Global EM Bond Index. He adds this augurs well from long-term demand-supply perspective, and he expects the yields to inch lower despite tight liquidity and firmer crude prices. He expects the 10-year benchmark bond yield to trade in a range of 7.05 to 7.2% with bull steepening bias.
Well, we have a lot of stock-specific action to track for you on the news flow that we saw over the weekend, but let's run you through our top 10 list that we're tracking for you. We're looking at Bajaj Finance, Sequence Scientific, Strides Pharma, Imami, Apollo Tyres, Vaibhav Global, Ircon, Sri Renuka, and Karnataka Bank. All of them on the back of positive news flow. But we expect Delta Corp to react to that tax notice that they've got, so that one will open up in the red.
That's going to be the big one, right? Delta Corp in today's trade. But back to the global market action. Last week was a bad one for the U.S. markets. The S&P 500 lower by 2.9%. The Nasdaq lower by 3.6% as the higher for longer rates narrative continued to gain some more ground. Let's get you some opinion now. Hear out Andrew Hollenhorst, the chief U.S. economist at Citi, and what he makes of Federal Reserve's latest policy action.
The economy is proving to be very resilient. And what the Fed needs to do, and I think what they indicated at their meeting they will do, is keep financial conditions tight. The issue that they'll have if they don't hike in November, maybe they could do it in December, November more likely, is they've indicated in their dot plot, in their median dot, that they're going to hike another 25 basis points. If they don't follow through with that hike, then the markets will ask the question, is this Fed really serious about keeping rates higher for longer? And even though it would be inconsistent with their guidance, markets will say, you know what, if they don't hike in November, maybe the next move is going to be a cut. And that's the risk that they have. So I think that just biases them to doing that final hike. Again, it's very much on the margin in terms of does that affect the economy. 25 basis points one way or the other isn't going to be determinative for the economy.
Before we slip into a break, here is a special announcement. Did you know that India's cancer burden has witnessed a sharp incline, with 70% of cancer cases being diagnosed at a very late stage? With a vision to reverse this pattern, News 18 Network, Federal Bank Hormis Memorial Foundation and Tata Trusts have come together for a special campaign, Sanjeevani United Against Cancer, dedicated to early cancer detection through regular screening. Watch Sanjeevani United Against Cancer at 8:50 p.m. tonight as we embark on a journey to save lives and promote a healthier future. Welcome back. Start of a brand new week, the last trading week of September, and these are the stocks that you should have on your radar this Monday morning. This is CNBC TV18's top 10 list of stocks for the day, and let's kick started with Abhishek on Bajaj Finance. Abhishek.
Rima, Bajaj Finance will hold a board meet on 5th of October to consider a fundraise. Just to alert our viewers, the Tier 1 ratio is at 23%. Jefferies has written a note on the same. They have a buy recommendation and a target price of 8,830 per share. They say that assuming Bajaj Finance raise about 10 to 15% of the net worth, the issue size may be about 8,000 crore or about $1 billion. So this would lead to equity dilution of 2%, and for FY24 the EPS could rise by 6% while the book value may rise by 11% respectively. So ROE may see a slight decline towards the 22% level, and Bajaj Finance is amongst the top pick amongst NBFCs for them. Back to you.
Thank you, Abhishek, and heartiest congratulations from the CNBC TV18 family. By the way, guys, Abhishek got engaged over the last few days, and he gets set to embark on a new phase, a beautiful phase in his life now. So congratulations.
Congratulations, Abhishek. We look forward to the sweets and candy later on in the day. Well, let's move on to Ekta. She's joining in to tell us about a couple of pharma stocks. Ekta?
Thanks for that. Well, I'll start with Sequent, where the US FDA inspected the company's manufacturing facility at Visakhapatnam, inspected from 18th to 22nd of September, issued only one observation, which they say is procedural, so I expect the stock to be in the green. Strides would be in focus because they've got the US FDA nod for a cardiac drug, which is the generic version of Visespa. Market size $1.38 billion, will be manufactured at the company's Bangalore plant. The company says it's another first cycle approval, which means that there were no queries from the US FDA, no deficiencies in the approval as well. Separately, the board is going to be meeting for the restructuring proposal by the company, and this will be to discuss it, something which was announced in terms of the Q1 FY24 numbers. The intent is to combine the CDMO interests of the group. There's an analyst call this evening at 5 p.m. as well. So that stock will be in focus on account of these two pieces of news. Expect both Sequent as well as Strides to be in the green today.
All right, Ekta, thanks very much for that. Well, Mangalam is here, back from his travels. Mangalam, welcome back. Morning. You've got news on Delta and Imami, right?
Yep, I thought travels would be from good news coming in from a lot of the casinos and all of that, but that's not the case for Delta. In fact, they've received GST notices worth nearly 17,000 crore rupees. The first notice worth around 11,400 odd crores, 11,140 odd crores, that's come in for the company directly. The other three notices worth nearly 5,700 crores have come for the three subsidiaries of the company. This GST demand is for a period between July 2017 to March 2022 itself. On its part, the company said that this demand is based on gross bet value and not gross gaming value. And the above notices are actually arbitrary and contrary to the law. And as per the company's all legal advice, they've gone ahead and will pursue all legal remedies available and challenge these demands. That aside, the stock has, of course, fallen about 33% from its 52-week high and is in F&O ban as well. So irrespective of what happens of this news itself, a regulatory overhang will continue to put the stock under pressure. The other stock that I'm watching out for is Imami, FMCG company, appointing a new leader. Manish Gupta has joined as President Sales and Consumer Care. He's got about 25 years of FMCG experience across Reckitt and a bunch of other companies, Walmart and GSK Consumer too. But in his last role, he actually helped build the distribution for Swiggy Group in India for their FMCG vertical. So two important insights. One, Imami could definitely do with support in distribution expansion and sales expansion. And secondly, the cycle of FMCG talent is turning. Back in the day, traditional leaders would join new age companies, but now we have someone from Swiggy joining a traditional company. So that's something I'll be watching out for.
All right, Mangalam, got it. Thanks so much for joining in. In fact, welcome back as well. You're definitely going to treat us later today. Moving across to Vivek. Well, he's here to tell us about some more stocks and news. Morning, Vivek.
Well, good morning. A few stocks on the radar on the back of news flow. First on our list, Apollo Tyres. Some positive news flow, after the strike and, halting of operations in the Gujarat facility. The company has updated the exchanges saying that, operations at the manufacturing facility at Limda in Gujarat has fully resumed. The next stock on our radar is Vaibhav Global, an important update coming in there. The company's subsidiary, which is called Shop TJC Limited, this is a company that is based out of UK. They've gone ahead and acquired an important asset, which is called Ideal World, which is a UK-based tele-shopping brand. Now, what Shop TJC will do is that they will acquire acquire Ideal World's IP rights as well as broadcasting rights. They haven't given the exact amount of this particular transaction, but the company has said that this transaction will be funded via internal accruals. And lastly, IRCON, another order win coming in. The company has executed a contract agreement with Sri Lanka Railways. This is under an Indian line of credit worth over 120 crores.
Okay, thank you very much for that. For more stocks which are in the news, Surbhi joins in. Hi, Surbhi.
Hi, Rima. The first one on my list is Sri Lanka. Now, the company acquires Anamika Sugar Mills for 236 crores rupees. Anamika Sugar Mills has a crushing capacity of 4,000 tons of canes per day. Their FY23 turnover was 295 crores. The company will also make a primary infusion of 110 crores for redemption of its preference shares, and the price of which will be decided at a future date. Also, the board has approved a fundraise of up to 285 crores via NCDs. The next on my list is Karnataka Bank. Now, the board has approved a fundraise of 1,500 crores, of which 800 crores is on preferential basis. They've approved to allot over 3.3 crores shares, aggregating of up to 800 crores at a price of 240 rupees per share to various institutions like HDFC Life Insurance, Bajaj Life Insurance, Quant Mutual Fund, and Bajaj Alliance General Insurance as well.
Okay, all right. Thanks a lot for that, Surbhi. Well, let's do a quick recap of all the top stocks we just covered for you. Stocks with positive news flow. Well, most of them are positive news flow, by the way. We have Bajaj Finance, Sequent Scientific, Strides, Imami, Apollo Tyres, Vaibhav Global, IRCON, Sri Renuka, and Karnataka Bank. Lone stock that could be reacting to negative news flow in our top 10 segment is Delta Corp. Well, Surbhi is still hanging on. She's gone through quite a few brokerage notes, so she's going to tell us what she's picked for today. Surbhi?
The first one on my list is on the metal space. Kotak Institutional has written on it, and they said that the Indian steel prices have firmed up, with long and flat prices up 10 and 4% respectively in the past 2 months. The price has strengthened, which is led by strong domestic demand and the recent spike in the raw material prices. Now, weaker monsoon and seasonal restocking has also led to the tightening of the domestic market. They expect the steel margins to firm up in the near term, and the cost inflation would require further price hikes to sustain the margins according to them. Now, they have a buy rating on JSPL, NMDC and Tata Steel, and they have a sell rating on SAIL. Next on my list is on Nalco. Motilal Oswal has written on it. They have a neutral rating with a target price of 95 rupees. They say that they have increased in alumina refinery capacity and raw material securitization, which is going to drive the performance going forward. Nalco has successfully acquired Utkal D and E coal blocks, which will improve their raw material security. The company is all set to operationalize the Utkal D coal mine block by the end of calendar year 2023. Now, this development will provide the company with an additional raw material security of approximately 2 million tons according to them. They say that currently company values at 3.8 times FY25 EV by EBITDA, and it appears to be fully priced in today's stock price.
Okay, thank you very much for that. Another stock you should have on your radar is Religare, where the Burman family of Dabur, but this is not related to Dabur, it's just the family, the promoters of Dabur, Burman family, in their personal capacity, hold stake in Religare Enterprises, and now they're making an open offer at a price of 235. The current market price is 271, so higher than the open market price. Let's get a complete roundup of all the action from the commodity and currency space. Manisha Gupta joins us this morning. Hi, Manisha. Good morning.
Hi, Nima. Thank you for that. Well, I'll start with the crude oil prices, where we have seen a firmness come back. We're trading above $90 a barrel. Three things to watch out. One is that Russia has banned, even if temporarily, the fuel exports to ex-Soviet states to ensure that the domestic prices stabilize. The second is the U.S. oil rig count, which has seen a decline, which now stands at Feb 2022 lows. Also, when you look at the U.S. Inventories that saw a decline previous week, the U.S. Cushing stocks also now at a July 2022 lows are a supportive factor. The third thing is about the fourth quarter deficit estimates that is supporting the prices. The EIA also has said that the oil output will decline from U.S. for a third straight month in the month of October. So we are looking at lower supplies from OPEC and allies and U.S. as well. We are looking at lower inventories. There are concerns about fourth quarter deficit coming into the market. With current demand estimates also, the expectation is that the prices will stay supportive. And if China demand does come back strongly into the market, then we perhaps are looking at even higher prices from here.
Okay, Manisha, thanks very much for that. We'll take a very quick commercial break here. We'll come back Prakash Devan will join in for some stock talk. A little later after that, Ankit Agarwal of Sterlite Technologies will join in to talk about their new manufacturing facility in South Carolina and, of course, the business outlook for them going forward. Stay tuned. Those two conversations come up next.
Welcome back. Well, the gift nifty suggesting that we open up more or less flattish. Last week was a rather weak one, but more or less a flattish start is what we're bracing ourselves for. As we said, Religare will be the stock in focus. The Berman family has launched an open offer at a price that's at a discount to what it closed at on Friday, at around 272 odd. The open offer price is 235 odd, but it gives some kind of a base out there. And some part of the street actually was expecting the Bermans at some point of time to go ahead and increase stake. If you pull up the last 6-month chart, you'll see that the stock is up, I think, more than 50-60% as well. And maybe you'll keep an eye on Eveready Industries as well, since they have stake over there. Prakash Devan joins us to fill us in with his analysis on a whole host of these stocks. Hi, Prakash. Morning. Prakash, I wanted to comment on Religare. You know, they have that insurance arm, which is bulk of the valuation. And when the management joined us a few months ago, they said they're waiting by for some infusion to come in there. But they also said that things are on the mend. How do you approach the stock around 270 rupees?
Good morning, Nigel. So I think this was definitely something that was brewing since a while. From the time that the restructuring effort took place and the company started getting to stand on its feet, the Burmans have been supporting it. And remember, there are a lot of marquee PE investments also that have investors that have participated. I remember Kedara Capital and some of the good names at that point in time. And all that repair on Care Health, which is the insurance arm that you're alluding to, is probably now market ready in that sense. So, the next logical step for them would be an IPO of that insurance arm and that standalone NBFC kind of getting to be moving towards profitability on its own. So I think it's a very good opportunity. We talked about this name at about 3,600 crore market cap, today is close to 9,000. So we've seen that journey in 2 years of repair. What's going to be important is that the timelines for the next few triggers also need to kind of start getting discernible, because once that happens, people will be able to start carving out some sort of valuation bump up in that in the current stock. But I'm not too sure whether this open offer gets through so easily. I mean, the discount is significant, and for all they might be testing waters out and then have to revise this thing upwards at some point in time.
By the way, there's an interesting note on Motilal Oswal when they analyze this Bajaj Finance's plan to raise some money. They're saying this current round of equity capital raise has come in much earlier than anticipated. Now, Bajaj Finance in the past has always communicated that its leverage threshold was 7x. In the last 3 instances, when Bajaj Finance initiated a capital raise, an equity capital raise, its leverage ratios used to be about 6.3, 6.6, 6.8. So closer to that 7x mark, its threshold, or between 6 and 7. This time, when the company is looking to raise some money, its leverage ratio is much lower. On a consolidated basis, the leverage ratio is only 5.2x. So that's why Motilal believes that why is it, raising money right now? It's coming in a little earlier than anticipated. One of the reasons could be because the AUM growth is likely to be much stronger and therefore they want some growth capital. Or are they readying some fund as Jio Financial Services also looks to grow in size and gain some scale? Prakash, how would you view Bajaj Finance's plans to raise some money?
No, I think you said it, Rima. The last part of your explanation is what I also relate to in terms of they're building a war chest to be able to go ahead at a much faster pace than industry in terms of their core area of lending. Remember, Jio is not as focused on to lending as much as to other fee-based services that they've rolled out or they've started talking about rolling out. So Bajaj Finance has that kind of breathing space. And, I think the lull in the consumer demand side that you've seen in the last 12 odd months is probably now at a bottom. So with the festive season coming in, there could be a new virtuous cycle of demand improvement for credit. And all these, time you've seen the banks also participate in some of the congruent markets, but which is changing now, given the fact that they are also looking at more of capital expansion from the corporate sector rather than individual retail loans. So Bajaj has its work cut out. They will need money for that. It's debatable whether they could have delayed this by another.
I think we lost.
But I think it's a company that has done well in the past, given its capital allocation, and that would continue. Whether to buy it at 700 or 7,700, the question is, it's always been richly valued. So you would have to look at some bad days to seek value out of buying into Bajaj Finance. But people holding it definitely are going to be very happy with the kind of growth that's unfolding.
Prakash, do stay on. We want to invite the first corporate on our show, STL, that's Sterlite Technology Limited. The company very recently launched a manufacturing facility in South Carolina with an investment of $56 million. Also recently, the company announced they've partnered with True Vista, which is a 100-year-old plus company in the United States for U.S. rural broadband services. And True Vista, too, will be making some investments. Ankit Agarwal, the MD at STL, is now with us on the show. Ankit, morning, and thank you very much for joining in. First, details about this U.S. manufacturing plant. What would the production capacity be? The peak revenue generation?
Yes, hi, good morning. Thank you for having me on the show. So yeah, we're very excited about having this facility come up. It's been a dream for us for a while. Just in setting the context, US is one of the largest markets globally for optical fiber. They're right in the midst of a multi-year network build-out for 5G, fiber to the home, fiber to enterprise, as well as for rural connectivity, where there is a $42 billion project called BEAD, which gets launched and goes live at some point next year. So the whole thought process was to tie up with our customers that we have. They have committed to us some sort of long-term agreements as well. And we recently launched 2 partnerships. One was Windstream, which is in the midst of a $2 billion network rollout across 18 states, as well as True Vista, which is also from the same location, same locality, and is also looking at providing broadband services and various applications in the region. Overall, for us, this is part of our overall strategy to become world top 3, which is we're very excited about. And in terms of North America specifically, this helps us provide better lead times, better customization, and better R&D for our customers locally.
Right. Ankit, hi, good morning. Prashant here. Would you want to put a number to it? As my colleague put it, what could be from this particular facility the peak revenues? At 100% utilization, what would you make?
No, so we won't be able to comment for competitive reasons in terms of specific revenues from this facility. But overall, what we had talked about was our investment and capex this year would be in the range of 300 to 350 crores. This is part of that investment. And certainly, as we see the capacities get fully utilized in the course of next, say, 4 to 6 months, we do believe that this will be a meaningful part of our overall capacity. To give some background, overall, we have planned about 50 million in fiber kilometers and around 42 million in cable capacity. So with this US facility coming up, then we'll be fully invested in terms of our capacities.
Ankit, last time you were on, you were saying that inventory in the US is quite high, and that's a problem. And you said that as we go into Q2, things perhaps will look a little better. Can you give us an update?
Yeah, absolutely. So, Prashant, I think that still continues. And even most recently, during our discussions with customers, we continue to see both elements of inventories, which continue. There will be still some period, I believe, around 4 to 5 months where the inventories will take time to reduce, as well as with the higher interest rates, probably some amount of second thoughts or slower deployment in the short term. While all our customers and other customers we're speaking to, potential customers, are talking about continued commitments from a 3 to 5 year perspective. So that's why we are also looking very closely at other geographies as well outside of US, like Europe, of course, our home market in India, Australia, etc., where we can look to increase our volumes.
All right. Hi, Ankit. Good morning. Nigel on this side. Ankit, what's your normal asset turnover?
So typically, for most of our investments, this year we are looking at capex of around 300, 350 crores. Typically, we look at return on our assets, return on investments in around 3 years is typically what we look at as return on investments. In the past, what we have seen is with various cycles of fiber and cable, we've typically seen faster returns on cable. And sometimes the glass and fiber investments take a little bit longer.
Okay, all right. Now, on this 300 crores that you're putting at optimal levels, what kind of revenues can you get? The payback period you've given us, I wanted the asset on.
Yeah, so say, for example, if you take a 5 million FKM capacity and you take on average about $15 to $20, you can make about $100 million of revenue annually on that investment. So that's typically the ratio. And we typically, the way we look at it is that we want to book with our customers for 2 to 3 years forward. And again, just depends back to the market scenario in terms of how they're willing to commit in terms of volumes and prices.
Ankit, you said US perhaps will take another 4 to 5 months to recover?
Yes, that's right. I think it's a combination of 2-3 things. I think one is the inventory that I spoke about. The second is the BEAD project, which I spoke about, which is a massive project by the US government. The actual funding will start flowing in probably second half of next year. So that will add a lot of impetus for our current customers and potential customers to scale up their network rollout.
So if US takes another 4 to 5 months, we're looking at a potential recovery only in Q4. I think you'd earlier hoped for a recovery sometime in Q3. So there is a bit of a delay. in the US recovery. So in that sense,
right.
will you still be able to achieve your full year revenue guidance that you've given of 7 to 9%, or do you think that will be at risk considering US is about 29-30% of your top line?
Yeah, absolutely. So as I said, it will now be a function of what more we can push across North America as well as in the other geographies. We continue to be bullish on other markets like Europe and India. So that's really where a disproportionate focus is going to increase our sales there. We do have our Italy facility running well. We do have our factories in India running. So the big priority will be to reposition some of our sales in these markets.
But you're holding on to your top. You're confident about achieving your full year guidance?
We're still evaluating it. I will probably have to come back post our results.
Okay, thank you very much, Ankit, for joining in. I think that's the key takeaway, that US demand is still going to take some time to recover. So the company is evaluating its full year guidance. Prakash, what are your thoughts on Delta? Now, that's going to be the big stock today as it's been slapped with that very large tax demand. Now, anyway, the stock is, facing the heat because of the GST issue, which came a couple of months back, about 28% being taxed on the overall money that people put in when they go to the casino. So the stock is nowhere close to the levels that it was. It used to be 250, 260, and now it's at 175. How do you think the stock will react to this news?
So I don't have any doubts. It's such a significant body blow of sorts for the business, for the stock particularly. But what I've noticed firsthand, Rima, is that in spite of the taxation being so significant, I haven't seen any let up in terms of the kind of interest people have in participating in what Delta has to offer. The activity levels haven't ebbed at all. So what it tells you is that while there is an element of pricing power, they can pass on some of the increased costs to the users. It is going to be significantly impacting the P&L. So while demand might not be impacted by this, it's going to be a profitability. So the whole business model will start getting questioned, and you'll have to work on very thin margins, and the kind of competition that exists. It's going to be difficult. So future expansion plans, all of that kind of any capex that they could think of will have to go back. They'll have to go to the drawing board again and figure out whether it makes sense. So I think it's going to be a significant shift in how the company progresses in terms of its business. Survival is the key issue at this point in time, given such thin margins, with such a tax outgo being so significant. So I would believe people will not want to kind of have too much of patience with what's going to happen. So everybody would want to wait and watch in terms of any repair. But till then, I don't think the stock is going to give you any solace.
Got it. Prakash, request you to stay with us for just a bit more. I wanted to ask you about a couple of more stocks in terms of fundamental analysis. But for the time being, let's hop across to Anuj. He's joining in to give us a quick trade setup. Morning, Anuj.
Morning, Nigel. Well, you know what? Just look at what's changed over the last 1 week or so. I'll start with the delivery volume of HDFC Bank. That really was the big change. You have over the last 3 days, total delivery volume of about 12,200 crores. That, I think, was the big change. Of course, the other big change was what happened in terms of the US Fed. That signaled, that the rate will be higher for longer. And the global market, because that went through a bit of a valuation reset. In fact, the US bonds, they hit multi-year highs. And the dollar index has surged to nearly 106. The biggest example of that was Friday, when the Indian market fell, despite that global bond inclusion, which was a big positive. In terms of Nifty levels to watch, the Nifty has given up exactly 50% of the September rally. The next level to watch, around the 66% retracement, would be 19,550. That's also where the 50-day exponential moving average is placed. The problem for the market is that except TCS and Infosys, all large stocks are in some kind of a bearish phase. HDFC Bank fell 8% last week, and that dragged the Nifty quite a bit. Reliance also fell about 4%. The basic texture remains sell on rally till 19,800 or thereabout is reclaimed. The first support for today's trade is 19,611. That's based on charts. And the bigger support is at 19,550 based on the 50-day exponential moving average.
Interesting there. Thank you very much, Anuj, for joining in. Need to slip into a very short break. On the other side, we'll invite Mitesh Thakkar and Sudarshan Sukhani for a few technical trading ideas. Stay tuned.
Welcome back. Hope you're having a good morning. Well, let's get you a couple of technical calls then on the markets. We have our experts who are with us this morning. Mitesh as well as Sudarshan join us on the show. Good morning, gentlemen. Well, Mitesh, you go first. Last week, you couldn't put it any other way. It was a weak session. The bears showed that, yes, we are alive. How do you approach trade? We're closer to around this 19,650-odd mark.
Good morning, Nigel. I think you're right in saying that last week was entirely, bearish kind of a week. My sense is that this fall has kind of changed the texture on an immediate basis, and therefore I think now it will be a market where I would want to sell on pullbacks or rallies. And 19,550 is something which I've been looking for, but there's a good chance that we might actually even break below that. So the next level which I'm watching closely is roughly about 19,350. So 19,550, 350 are the two targets for me. And I think on the upside, it will be very difficult for the index in the short term to get past 19,850, which was the high of Thursday, and we had a gap down on Thursday. So I think the 19,850, 900 zones would attract strong selling on the upside. And therefore, any 100 point, 150 point kind of a pullback, if you are able to get it during the week, I would want to build up short positions over there.
Okay, well, texture seems to have changed a bit, as Mitesh put it. Gentlemen, good morning. Good to have both of you here. Sudarshan, how are you looking at things?
Well, I'll give you a short-term view because it's very difficult to say how the markets will behave in the near future. The fact is that the Nifty is likely to open around 19,600 support. Now, that support is a decent support. It is possible that the markets may try to find if they can begin a rally from here or at least start a process of consolidation. So for today, I would be a buyer in the Nifty on any kind of a sign of strength with a tight stop at 19,550. The stop loss must be observed. If you see that the Nifty is stopped falling, does not fall, consolidating, trying to go up, then it's worth buying and finding out how much steam there would be in this, say, relief rally. But the trade today for me is to look for a buying opportunity. That applies to the Nifty Bank also. Although the Nifty Bank has a chart that is inferior to the Nifty in terms of its bullishness, but still it's somewhere around 44,500. It's finding support. That should be touched today. With a 200-point stop, buy a deep decline in the Nifty and the Bank Nifty also.
Okay, got that. Sudarshan, you go first to tell us what are your individual trading calls that you have?
Persistent Systems is a buying opportunity. It had a big run-up. Now it's in a consolidation. Such consolidations usually break on the upside. Buy with a stop under 5,700. Oberoi's Realty is in an intraday short sell. The stock is now giving signs of distribution, suggesting that a correction may be coming with a stop at 1140, above 1140, intraday short for Oberoi Realty. Crompton is another intraday short. That seems like a positional short also. A large bearish pattern has been confirmed. But for intraday short, stop above 303. Finally, Z is a buy. Similarly, just as big rally like Persistent. Now it's been a trading range for two months almost. Such ranges usually break on the upside. Buy with a tight stop under 255.
Okay. All right. Mitesh, what about you?
Nigel, there is some kind of a breakdown happening on the pharma index. So I have two stocks from that side on the sell call list. Dr. Reddy's is a sell with a stop at 55.80. And I would look at a test of around 5,400, 53.85 as the target area. And Lupin, I want to sell if it breaks the pivot of 1,090. So it's a sell below 1,090. It could happen today sometime in the noon. And then keep a stop at about levels of 1110. Look for targets of 1,055. And I also have Info Edge as a sell call, which on a mild bounce back, say around 43.25, 43.30. Sell positions can be taken with a stop at 4,400 for targets of around 41.50. And one buy call, that's Indian Hotels. Keep a stop below 400, look for targets of around 421.
Okay, well, gentlemen, good to have both of you here with that perspective, with those thoughts. We'll come back to both of you in just a bit from now. We'll take a break as well. The pre-open session is 6 minutes away. We get you an exclusive conversation on the other side with Vibha Padalkar, Managing Director and CEO at HDFC Life, on how business is looking for them, one of the largest private sector insurers in the country. Stay with us. Okay, welcome back. Chandan Dhaparia is now joining us, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, good morning. Good to have you with us here. You know, as I think Mitesh was earlier pointing out, the texture, at least in the near term, seems to have changed a little bit. What did you see on Friday in terms of activity on the futures and options side, and how are things looking as we start another session?
Good morning, Prasanth. Thanks for having me. Yes, the structure has slightly changed in last couple of days. Short-term trend is making lower highs, lower lows on the daily chart in Nifty and Bank Nifty both. Just a couple of days back, Nifty made the new lifetime high of 20,222. And after that, we had witnessed correction of around 560 points. So resistance are shifting lower. We have seen decline in the put-call ratio. But only thing is that even after the market decline, we have not seen surge in the India VIX. So that is somehow indicating that we might find bottom in next couple of days. But we will be with immediate trend that is negative on daily chart and believe that till it holds below 19,800 zone, index can see some more weakness towards 19,500 to 19,350 level. Looking at the Bank Nifty index, it is also making lower highs, lower lows on daily chart. It witnessed correction of around 1,600 points. Bank Nifty recently failed to surpass its lifetime high of 46,369. It turned from 46,300 level. So now till it remains below 45,000, which is a new hurdle led by call writing as we are heading into the monthly expiry. So till it remains below 45,000, we may see some more profit booking decline towards next support of 44,250 level. So both the indices are in pressure on short-term point of view and trading lower than their volume weighted average. And this is the time for expiry week on monthly basis. So kept upside will be there in the market. Now looking at the stock wise, again selective buy and sell idea here. Recommending to buy on Maruti. This stock is holding well. We have seen open interest addition of around 7 to 8%. Put writing is clearly visible. Put call ratio is holding in the individual counter. It is all set to give the fresh breakout and heading towards the new high territory. So recommending to buy with support of 10,250, and here we have potential target towards 11,000 zone in the Maruti. Selective auto stocks are holding, and Nifty auto is comparatively showing a strength for the next leg of rally. Second trading idea, that is buy on REC Limited. This stock is up by around 13%. Series on series basis longs are being added and carrying to the new series. Even after the long built up, we have seen some short covering, which indicate further momentum in the counter as we head towards the monthly expiry. So recommending to buy on REC Limited, looking at its price and the data structure. One can buy with support of 265. And here we have a target towards 283 and somehow expecting some call unwinding pressure in the counter as well. Last trading idea, that is sell on SBI card. Weakest structure, making lower top, lower bottom. Shorts are intact. So expecting further decline towards 770. One can sell on a small bounce with hurdle at 818. So this is all what you need to work in this market.
Okay, all right. Thanks a lot for that, Chandan. But Religare, that's going to be the stock in focus on the back of the news that's come in earlier today. That the promoter entry, that's the Berman's, not the promoter entry actually, the Dabur promoter, they are going to be going ahead. And in the individual capacity, going in increasing stake and then launching an open offer as well. Vivek joins us to fill us in with more details. Vivek?
Well, absolutely right. You know, they've been steadily increasing their stake in Religare Enterprises. So the Berman family, remember, they already control two listed entities, both Dabur as well as Everready. And this will be the third listed entity that they will be controlling in case the open offer, does get successful. So, at the end of the June quarter, the Berman family held 14% stake. In this current quarter, they've acquired an additional 7.5% stake. And today, they've gone ahead and told the exchanges that they intend to acquire another 5% stake, and that particular stake the price will not exceed more than 234 rupees a share. So on the back of that, the mandatory open offer limit will be triggered since the holding will go ahead and exceed the 25% stake. So on the back of that, they have also made an open offer to acquire up to 26% additional stake in the company, and the price for this particular stake buy is at 235 rupees a share, which is a steep discount, to the current market price of the company, over 13% discount. However, what they believe is that, they believe it's the right platform, and what Anand Burman has said is that they want to enter into the lending, broking, as well as the health insurance service, and they believe Religare Enterprises will be the right platform for that particular stake. The stock will definitely be in focus. The stock has run up quite significantly, but the open offer getting triggered, as well as new promoters coming in, is something that is being seen as an important trigger.
Okay, Vivek, thank you very much for that. So that is Religare for you. Let's just take a quick look at what the opening is. Look at the rupee, by the way. We closed at 82.93 and we are past the 83 level this morning. So yeah, I mean, there is pressure which is coming through on the dollar is stronger, the rupee is weaker as compared to where we left off on Friday's session. The Nifty will come up on your screen as well, and we'll have the pre-open rates for sectors, stocks, etc. 20 points lower, so 19,654. This is largely in line with what the GIFT Nifty was indicating, but this is just the start. Now, in previous conversation with CNBC-TV18, Vibha Padalkar, Managing Director and CEO at HDFC Life, has given a very strong guidance on business. Now, in an exclusive new conversation with my colleague Yash Jain, Ms. Padalkar says that she will stick with the guidance that she's given out earlier. She clarifies on the continuity of her term as Managing Director and CEO amidst ambiguity on the regulations there. Listen in to this conversation.
Nothing really has changed in terms of when we spoke last. 1 or 2 months here or there will be there, there's some contest or there's some other, some festival that is there. If you were to look at August, just for the standalone month that just went by, we grew 16%, comfortably ahead of the overall sector. So that kind of a trend wherein we have said we will grow this year because of the tax changes in mid-teens, that still stays. Now, what this doesn't factor in is any kind of regulatory relaxation or tax relaxation or something like that, or any other macro event. So we are very much on track to get to the mid-teens growth number on the overall APE basis.
What has been the status on VNB as far as the second quarter is concerned? And if the first quarter and the second quarter, that is H1 itself, is about 18%, around that number, could the second half be even better than your guidance, going up all the way up to 20%?
See, if you were to look at first quarter, there were some things regarding the Exide Life merger, because like I had mentioned, Exide Life was in single digits versus where HDFC Life was. And so on a blended basis, including Exide Life, you would have seen that uptick of the 18% that you are talking about. I think margins, like I had said before as well, NBMs will remain fairly range bound versus last year, and growth will be in the mid-teens. As a result of which, on a full year basis, VNB growth will be in mid-teens. Last year got a fillip because of the tax withdrawal to some extent, and so even getting to that number in terms of new business margins will be a challenge, but we will deliver on that. Okay. So margins will be and if you remember, about 900 to 1,000 crores of additional business was done just in the month of March in FY23. That itself is very, very margin accretive because of it being additional. So keeping all that in mind, getting to that number itself is something that we will deliver, but it's something that we will be working towards.
Are there more strategies that you're working on to sort of, go past that 30% psychological level? Are there more strategies in terms of products, in terms of distribution, that could sort of, be a good leverage to you to go past that 30% mark?
Absolutely, and some of that is ensconced in the draft insurance amendment bill. For example, health. This is a missing piece in the puzzle, and I've talked about it time and again, that when you have a prospective policy holder, you cover everything except health indemnity. Also, we could utilize this to sell more health riders and so on, and the pie really needs to be expanded. So we have no intentions of just redividing the pie, but how do you grow the pie? It's not even 1% in terms of penetration levels, right? So, really, the opportunity is huge. That is one. Second is that, again, in the draft bill, we have wherein distribution of other financial services products. So if banks can distribute insurance to regulated entities, why can't insurance companies distribute? It could be banking products, it could be pension products, which today we cannot do. Again, very margin accretive, not very dissimilar to what banks go through. It's a question of if the customer is walking into any touch point, be it at a bank branch, be it at an insurer's branch, be it at a general insurer's branch, be it at a NPS touch point, we should be able to give that one-stop shop if the customer so desires. So that's the objective. That again, very, very margin accretive. And third is again the ask in terms of being allowed to invest in insurtech companies.
At the start of the year, we had the big announcement in terms of taxation of long-term savings products. It's been reasonable amount of time since then into business. To just look at it objectively through numbers, last year, first half, what was the share of long-term savings policies as far as your premium portfolio is concerned? Where does that share stand now? How much has it reduced from where it was last year?
So we were also surprised. Few data points I want to give you. One is that below 5 lakhs, our policies have grown about 15 to 17%. So healthy growth in below 5 lakhs, right? And so like I put out, this is on 1st of February, to say that about 10 to 12% impact. It's not very different to that. Okay. And this whole machinery of below 5 lakhs has started kicking in very nicely. As a result of which, if you look at first quarter, our number of policy growth, which is very important now that ticket size growth has gone down because they are above 5 lakhs. So our NOP growth has been was in the first quarter 9%. But if you look at the NOP number of policy trending now, it's in the 14 to 15% range. So that clip of more and more lives and more people that the entire machinery is starting to engage with and then convert into policies has started happening. Okay. Yes, it will take some time in terms of the above 5 lakh in some of our wealth channels. But mass and mass affluent, that whole engine has started kicking in and very evident in the number of policies.
You know, a recent development. On a general insurance company side, of course, one of the individuals leading that company tendered his resignation because of the regulators' regulation on 15 years into service leading a particular company. Now, there is some confusion on whether does it apply on the duration of the individual being at the top position, that is the managing director and CEO, or being on the board seat. For you, you were appointed as the ED in August 2012, elevated as the CEO in September 2018. Now, just want to understand from you to clear this confusion, does it apply in terms of 15-year duration from August 2012 or September 2018?
The regulations issued by IRDAI, this is effective 30th of June of this year, did have wordings to this effect, and our interpretation was that the counter starts from when an individual assumes office as MD and CEO, given that these two roles and responsibilities are very different. We did seek clarification from our regulator, and our view was corroborated by our regulator.
So then in that case, if the understanding is right, then you have time till, let's say, September 2033 if you want to continue in the office as MD and CEO.
And if the board and shareholders are also acceptable to that idea, yes.
Okay, interesting chat there with HDFC Life CEO counting down to the opening. Sudarshan is still with us. Sudarshan, what will the 9-10 call be?
Persistent Systems is a buy with a stop under 5,700.
Mitesh, your 9-10 call?
Yeah, I'll go with a sell on Dr. Reddy's with a stop at 55.80 for targets of 5,400.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's hop across to Mangalam. He's come back from his vacation. He's feeling the momentum. Mangalam, what's the stock on a momentumizer segment today?
Well, Nigel, it is ITI. Before I went on leave, I was looking at the stock. It was 120, 130 odd rupees, and now suddenly close to 200 rupees. So I was wondering what the momentum is all about. And I just looked at it on Friday. It was a 10% up move that we saw on the stock. And that's not all. In the month of September itself, it's rallied close to around 60 odd percent. In the earlier part of the previous week, it was a little above that 210 odd rupees. So the first few days, it saw some profit taking, but on Friday, it came back with a bang with a 10% upper circuit as well. Earlier in the month, the company did announce to the exchanges that they've gone ahead and developed branded laptop and micro PCs called Smash with international standards. So perhaps a play on the manufacturing of laptops in India itself. But nevertheless, it's seen a lot of momentum. It's still about 10% away from its 52-week high. The question is where it goes from here.
Okay, thank you very much for that. Back to Abhishek for more on Bajaj Finance and Karnataka Bank. Abhishek.
Well, lenders are looking to fundraise. So Bajaj Finance will hold a board meet on 5th of October to consider a fundraise. Now, analysts estimate that the fundraise could be around $1 billion or about 8,000 crore. Analysts also say that this would lead to equity dilution of 2%. So they estimate that FY24 EPS could increase by 6%, while book value could rise by 11%. The ROE may fall slightly towards the 22% level, and BAF has been amongst the top pick of many brokers. So Karnataka Bank fundraise of 1,500 crore, they have done a preferential issue of about 800 crore from this 1,500 crore that they had approval of. So preference issue has been done at 239.5 per share, a discount of 0.9% to Friday's closing price. Preference issue investors include Quant Mutual Fund, Bajaj Alliance, SDFC Life and Bharti AXA. This 800 crore of fund infusion would mean Tier 1 ratio increasing towards the 17% level from 13.8% earlier. Book value declines by 0.7% to 256.6 per share, and equity dilution of 10.7%, while net worth increases by almost 10% to 8,874 crores. Back to you.
Thanks a lot for that, Abhishek. Well, I'm looking at cement, and DAM Capital, they have come out with a note on cement. They say that cement pricing has witnessed quite a bit of strength in the month of September, and that's been led by East India, where we know prices have moved up by 40 to 50 rupees. There have also been price increases that have been followed up in North as well as Central India. That's by around 10 to around 15 rupees. So they say that now South India is on its way to course correction. Remember, South India, things have been quite weak out there in terms of demand, in terms of pricing as well. Dealers have indicated, according to them, that prices could move up by around 40 to around 60 rupees in the first week of October. The quantum and sustainability, though, that will depend on the kind of inventory levels that customers are sitting on. So they are focusing on mean reversion in South India. They say that pockets of, Tamil Nadu as well as Kerala could look up, because South India, well, they've been the biggest casualty in the last 9 quarters or so because of inflationary worries. The clinker utilization levels in select clusters of Tamil Nadu, well, they are looking up as well. And the key beneficiaries would be Ramco, you'll have India Cement, Sagar, as well as Dalmia Bharat. Now, they continue to remain bullish on the cement space on the whole. Couple of factors that they have lined up here. In Q2, they're working with 100 rupees per ton improvement in the EBITDA per ton. They say pricing has been positive in the past quarter. Input costs have cooled off as well, and risk reward is favorable. They have listed out their top stocks among large cap. They like Ultratech as well as Dalmia, and the mid-sized companies. They like Ramco as well as Nuvoca. That's why, in fact, all the stocks could be in focus.
Okay, interesting list. Keep your eye on cement names, and counting down to the opening, 7 seconds left. After 4 days of losses, can the market stage a bit of a comeback today? The opening is likely to be absolutely flat. The first tick on the Nifty is in the green. We have opened around 19,700, a gain of 23 points. The sensex higher by 75 points. So it's a flat opening, but with a positive bias, a gain of close to about 0.1%. Mid-caps too have opened with some strength, up close to about 0.3%. The top gainer today is Bajaj Finance, 1.5% at opening. This is ahead of a board meeting on the 5th of October, where they will ponder some fundraising via a preferential or the QIP route. Other financials like Bajaj Finserv, Kotak Mahindra Bank have a green tick. State Bank of India too, which is one of the big movers on Friday, is higher. You've got strength in pharma names like Cipla and Dr. Reddy's. Apollo Hospitals too has a green tick. On the losing side, softness seen in Hero MotoCorp, that's down 0.8%. IT is on the back foot. So Infosys, HCL Tech are under pressure. Remember, Accenture reports their numbers on Thursday, and that will truly give us an indication on whether there has been some pickup in the quarter gone by. So Accenture reporting numbers is often seen as a lead indicator for IT companies in terms of a demand trend. But given the fall that we've had on NASDAQ over the last couple of days, IT is a bit subdued in trade. Axis Bank is now selling off. In fact, the Nifty and the Sensex too have dipped into the red. First, it was up 25 points on the Nifty. Now we're down 24 points on the Nifty.
All right, Rima, let's run you through some mid-cap names and 2 stocks that are getting hit very, very hard. Relicare, we had the news early this morning that the Burmans, they want a bigger chunk of the company, but the pricing was a disappointment. The stock closed at around 272 rupees. The open offers at around 235 rupees. That's one of the top stocks on the downside. Giving it company on the downside is Delta Corp because of the massive tax notice that they've got. The stock is down close to around 10%. It's locked in lower circuit, actually. Stocks that are moving with very, very high volumes include PNB Gilts. Remember, they have a high amount of exposure to bonds. And because of the inclusion of Indian bonds into the emerging market bond index, well, you could see bond prices could move favorably for them. And that's why the stock, after being up 20% in Friday's trading session, it opened up with a gain of 3%, but now it's flattened out more or less. Suzlon, that's another top volume mover. That as well is up close to around 3%. So, Prashant, more or less, those are the broad stocks that are moving on very, very high volumes. But the Nifty, well, that's moving lower. And now it's approaching that crucial support zone of around 19,600. What else?
You know, just a few other names. By the way, the market breadth is quite positive. Some almost a little over 2:1. 1,200 stocks are higher and about 600 stocks are lower. The top stock is Swan Energy, which is coming up with a 13% gain. But, you know, it's also the top volume traded gainer. And that's the reason why I'm highlighting that Swan, not Suzlon, SWAN. So 336, 337 on that one is what you have. Big volumes, by the way, 1.4 million shares off the bat. ITI, Mangalam was just pointing that out as a momentumizer name. 4% higher on that one, 198. Again, huge volumes. Again, 1.4 million shares on ITI at the word go. There is Nelcast, which is up 9%. So this is an unusual mixed straight off, which is coming up with gains. Again, volumes are 1.3 million on Nelcast. Suzlon, we put that up earlier. It's up 3% as the fourth largest volume gainer. There is Tata Investment Corporation. So that's 2% higher. You know, KNR Construction comes up with about a 4% gain right now. So that's at about 283. And what else? Electra Green Tech is up about 1.25, so small. Senco, we were highlighting that towards the fag end of last week. I think some initiations on Senco, but the stock this morning is up 5%, 524, sort of predominantly East India-based jeweler. Gland Pharma, Bajaj Healthcare are some of the other names which are coming up with decent-sized gains on the back of volumes at this point in time. Berger Paints is down 4.5%. I'm not sure if there's any specific news flow, but Berger at about 640 and on the back of some decent sized volumes. So flows are there. GMR Power is down 3%. Religare we highlighted. Delta we highlighted. Maybe a JSW Energy, which is down 1.5%, and Nazara, which is down 2% as well. Perhaps we put up. So that's largely the summary that we have. As I'm kind of commenting and picking out what's moving both up and down, market breadth is completely flattened, more or less now 1:1 from being 2:1. So 950 stocks are higher from 1,200. That's shrunk to 950 in 5 minutes, not even, actually a couple of minutes. And you've got 900 stocks which are lower. So that gap is just completely sort of narrowed and gone. The advances to declines 35 points lower, 19,640 is where we are on the index. Manishi Ray Chaudhary is with us, Asian equity strategist, Equity Cash Asia Pacific at BNP Paribas. Manishi, good to have you with us here. Thank you very much for your time. Are we beginning a bit of a global correction in your opinion? What is your global team's view?
That correction began some time ago. You know, it coincided, and not surprisingly, with the US bond yields spiking. In this particular case, it was accompanied, somewhat surprisingly, with global energy prices, oil prices also going beyond 90, now approaching 95 to the barrel. And both these variables are actually, not quite helpful for Asian equities, particularly Indian equities. We have seen, consequently, the Asian currencies depreciating, and we think that this situation is likely to continue for some more time. So essentially, this is not really an India-specific phenomenon. If we are seeing it across emerging markets, whenever you have the US dollar appreciating, the US bond yields spiking, there's a flow of money in favor of the safe haven destinations like the US markets. And, I think this kind of a situation may continue for some more time. Now, having said this, India is in somewhat of a sweet spot, when it comes to protection that the market has because of domestic fund flows. This is something kind of unique to India. Almost no other emerging market has this advantage to the extent that India does. So I would think that the entire emerging market complex, the Asian markets, would possibly continue to have some correction. That said, the outperformance by India, even in that corrective phase, would likely continue.
Manishi, morning. Rima here. Just to, labor on that point that you were making about the global markets getting into a tired sideways movement, as you call it in your report. You're saying this currently what we're seeing is similar to what happened in 2002, 2003. And at that time, the market declined. Then it drifted throughout Fed's rate cut period as concerns about a sharp economic slowdown became apparent. And the recovery started only after the Fed rate cuts were almost over, as the liquidity injected began seeping into the various financial assets. So are you saying we're in this grinding kind of period for a very long time, even as the Fed starts its rate cutting cycle? Perhaps sometime next year, markets are still not going to react positively?
I would think that this, tired sideways movement, which, very correctly quoted from my report, is likely to continue for, maybe another 3 quarters or so, maybe till the middle of 2024. We're in exactly that phase which we encountered, from mid 2002 to mid 2003, where the markets were directionless. The earnings estimates were kind of coming down, but selectively, very selectively staying stable. And we're possibly in that kind of a situation right now. What would be necessitated to sort of take the market out of here? We clearly need to come out of the recession narrative. And that narrative, unfortunately, is likely to continue until and unless the recession is actually over. And our global economics team thinks that that period will coincide with the first and second quarters of 2024, where we will have a shallow recession, but a recession nonetheless in the United States. Mid-2024 would also coincide with, hopefully, the end of this higher for longer period. We think there could possibly be one more rate hike in November, but after that, there would be an extended period of higher for longer, maybe for another 3 quarters, and rate cuts would commence only in the second half of 2024. So when I put all this together, the macro variables would turn favorable for risk assets only in the second half of 2024. Until then, I'm afraid we may have to contend with this sideways movement.
Hi, Manishi. Manishi, what about HDFC Bank that's already been underperforming? It's not even sideways. It's actually down close to around 7%. And I think in the last 10 years, we haven't had a single year when HDFC Bank has given negative returns. And we just have 3 months to go. So hopefully it keeps, that record in terms of positive closes in a calendar year. You've liked private sector banks. Where does HDFC Bank feature in that list?
Right. So, I wouldn't obviously comment on, stock specific here. But in general, as you rightly point out, we do like the private sector banks in India. And we focus on those banks which are gaining market share. The entire gamut of private sector banks in India are gaining market share over the PSU banks. But even within that set, there are a few which are actually, for more adept at cost cutting because of better technology that they have. They're also gaining market share as a consequence of that better technology that they possess. And, and those are the banks that we're focusing on. So that, it's certainly, that's the story that would pan out, not just over the next 1 to 3 years, but even for much longer.
Right. Manishi, sorry, this, we're in a place where oil prices are up 30% from June, the dollar is higher, etc., which some of this you discussed. But then on Friday, we got that global bond index news flow, right? So should we look at some of these, the two big global variables for India, dollar and oil, a little differently? It would still hurt, but maybe to a lesser degree. What's your sense?
I do tend to agree with that. If one looks at the global bond index inclusion, from the debt markets, we have the feedback that it would lead to anywhere between 25 to 30 billion inflow on the lower end of the estimate range. and possibly somewhere around 45 to 50 million on the billion rather on the higher end of the estimate range. So that's significant. And that inclusion is happening in June 2024, which would obviously have a salutary effect on the currency. Now that said, it's going to be a long drawn out affair. It'll basically pan out over the next 9 to 10 months. And before that, we will have to contend with higher fuel prices. We must also keep in mind that we're entering the winter season, where obviously there's a degree of pressure on the oil prices in the upward direction. So it's basic.
Oops. Okay, I think we lost the line there. There was a freeze frame, but we'll just have Manishi back to complete that point. The index is now coming back into being absolutely flat. We were down about 20, 30 points. We're down 2.5, so absolutely flat now on the Nifty. Just take a look at the Nifty Bank as well, which outperformed what the Nifty did. The Nifty corrected on Friday, but Bank Nifty ended unchanged. It's already in the green, the Nifty Bank that is. Just to kind of go back and look at stocks, etc., Berger is the only significant kind of loser with about a 4.5% cut. There is, of course, the news-related ones, Religare and Delta. Religare, by the way, was also picked up. It was down 6.5%. Religare is now about just 2.5% lower at 264 or so. So, a fair bit of pickup from the low point of the day. Manishi, I believe, is back with us. Manishi, please, we lost you there. Go on.
Yeah. So I was talking about this bond index inclusion. And there's a significant degree of flows expected, possibly about 25 to 30 billion at the lower end of the estimate scale, 45 to 50 billion at the upper end of the estimate scale. So this is significant, no doubt, and it would support the currency. What we have to contend with is actually the near term. When oil prices would likely continue to be firm, we are entering the winter season now. So I think, when it comes to this question of currency, there's a degree of difference between the near term and the longer term that investors would have to contend with.
Manishi, wanted your thoughts on Indian industrials. In your portfolio, you do have holdings in L&T and BEL, so you are playing the Indian industrial space. The question is, how long do you think this government capex will continue? They've been spending massively, but can we assume this kind of government spending for the next 3 to 5 years? Are we closer to the end of this upcycle in industrials, or it's just gotten started and you would play it for the next 3-5 years?
We would definitely play the government capex theme, and therefore the consequent spilling over into private capex. We must remember that private capex hasn't really started in a big way yet. You rightly point out, and this is something we have been arguing as well, that if you look at government capex in infrastructure, in railways, in defense, all put together, capex as a proportion of total government spend has skyrocketed over the last 3 years. It used to be about 17% of total government expenditure. It has gone to about 25 to 27%. The only risk to this could be, a spike in the fiscal deficit. Now, if I look at the tax collection that we're witnessing at this point of time, that doesn't seem to be a very potent threat at this point of time. So looking at the government's intentions in terms of supporting capex and improving infrastructure, I would be willing to bet that this government capex would likely continue for over the next 2 to 3 years at least, and the spillover effect in the private capex would possibly accelerate. So yes, we are currently overweight. We have a significant allocation to Indian industrials in our model portfolio, and we see no reason to alter that.
Manishi, great conversation. Thank you very much for joining us this Monday morning. Let's move on and invite the management of Krishna Institute of Medical Sciences, KIMS as they call it. That's the next corporate on our radar today. Now, the stock has seen a stellar performance this year. It's up 50% in the last 6 months. The company recently made further investments in Kondapur Healthcare and has brought another 11.5% stake in Kondapur Healthcare, taking their overall stake to 28%. B. Bhaskara Rao, the managing director at KIMS, is now with us on the show. Mr. Rao, morning, and thank you very much for joining in. First, if you could talk about your investment in Kondapur Healthcare. You currently hold 28.8%. Do you want to increase your stake further so you have a controlling holding in this particular, in this investment? And the rationale behind it, what do you hope to get out of this investment?
The Kondapur, we have a listed company, has an existing subsidiary, 91% stake as of now. Now that is running around 92% occupancy. And there is a lot of scope for the KIMS to grow in that area, in that geography. That's why there was a big of 6 lakh square feet is coming. We are able to accommodate 600 beds in that space. Right now, what we have is only 200 beds. Now, in that, later on, we want to, once the entire building is ready, we would like to take it on a lease, a rental basis, and enable to run it for some time. Later date, we can able to see whether we can able to buy and merge into KIMS Kondapur, because these in 91% of KIMS, 9% is only the other doctors who are working in that entity is having that stake. So they love to have in the same area and to build the healthcare there in the geography. In that, that's why we have an opportunity to invest 28% of the stake, but over a period of time, maybe we can able to increase depending upon the requirement of the construction, both equity and debt, what they need. If there is any requirement, KIMS subsidiary would like to invest further. May not be for next till it will take about 25 March is the line that we have been put in, that the entire construction will be over. Till that time, we will be around less than 30-35%, unless it forces us to invest more if there is a need of either banks are not funding or anything. Otherwise, we will stay as it is right now.
Got it.
But we won't go into the majority of the stake in the next 2 to 3 years.
Okay, you can go
Once
up to 35%.
we shift over there, and then we will decide whether it will be worth. So basically, we want to see a asset-light model in that area, and later on, once the capabilities is there, then we'll be able to work on that. Thank you.
Okay, Mr. Rao, good morning. Good morning. So you have a hospital, a 200-bed hospital, which has been functioning, right, for the last many years.
Yes.
In that venture, you have 91%. This is a new hospital which is coming up in the same region. Maybe close by.
Away.
Okay, so pretty much the same complex, almost contiguous. And in this you have 28%. You can go up to 35% by 25 if need be, is what you're saying. And once this is constructed, this is a greenfield project. How many beds will this have? And once this is completed, including any expansion at the existing 200-bed facility, how many beds will you have in Kondapur?
In Kondapur, once this is finished, it is a 600-bed hospital. So that will be a good size in the geography. Right now, we have only 200 beds. Most probably, at that time, whether we are happy with that 600 beds, we may able to close the existing, which is a rental building, and then we will shift the entire thing towards the new facility.
Got it. All right.
We are not able to add few more specialities there because lack of beds. So those specialities we can add once we have a 600 beds there.
Got it. Okay. All right. Mr. Rao, I want to talk about a couple of other acquisitions that you did. And I'm looking at a brokerage note that's from IIFL. They're talking about the Sunshine acquisition that you've done in the recent past, as well as the Kingsway Hospital. Now, they've given some estimates. By 2026, they believe that on Sunshine, the EBITDA could go to around 200 crores. I think the last recorded number was around 85 crores. And, on the Nagpur Hospital, I think it was around 5-6 crores, or they believe it can go to 55 to 60 crores. You agree?
So what is happening is the Sunshine have two facilities. One in the Paradise, another one is the Gachibowli. The Paradise facility is pretty old facility where we could not able to attract good talent, and it is a rundown the facility. So we bought one more facility nearby to that existing facility, which we are going to on the way to shift to the new facility. That got delayed about 1 or 2 quarters. Once that facility has been shifted, there is a new talent which are already identified. They are coming and joining, and then we are pretty confident that we can able to scale up to what we are achieving when we bought the Sunshine Hospital. We are 100% sure that we will be able to achieve. The Gachibowli is also a small facility, about 250 beds. We were able to operational efficiency made with the high-end cost of the doctors we have removed, and we are recruiting more and more talent. That is also, as we expected, it is keep going up. So we are pretty confident. Maybe 1 or 2 quarters this way or that way, we will achieve what we are expecting to do that.
So what's the current capacity at KIMS? And once all this expansion comes on stream with your new investments in hospitals, etc., what would the bed capacity at KIMS be? Why your subsidiary and your investments?
Sorry, come again?
Mr. Rao wanted to understand what is the current capacity across, all the regions and hospitals, and once all this increased capacity, increased beds come on stream, whether it's in Gachibowli, Begumport, or even in Kondapur, what would the total beds at KIMS stand at?
So as of now, we have 4,000 beds. In next 2 to 3 years, we are going to increase up to nearly another 3,000 beds. Out of these 3,000 beds, nearly 1,200 beds are going to come in the existing facilities itself in Andhra and Telangana. Nearly 1,800 beds are coming from Maharashtra and Karnataka, maybe Tamil Nadu.
Okay. And sir, all this investment to increase your bed count by an additional 3,000, how will you be investing? What's the amount that KIMS will require to spend to increase this? And would you be open? Would you be interested? Do you think you will require some incremental funding coming through?
No, we don't require any incremental funding. Whatever is the internal accruals that we are getting, in the next 3 years, we may be having around nearly 1,500 crores of the cash that will come into the internal accruals. And another maybe 1,000 crores if we take it as a debt, that will be enough to fund all these 3,000 beds.
Right, Mr. Rao, so all of this, right, will come into fruition sometime in FY26. I mean, if one looks at your revenue growth, I think in FY23, actually, if you look at the EBITDA growth, that was about 19% in FY23. Could you tell us how this will shape up, say, not in 24, but 25? And I was looking at estimates by analysts who cover, your company. The kicker will come in FY26, I believe, if you can confirm that.
So 25 January onwards, we are expecting a few of the beds are going to functional. At least 600 beds in Andhra and Telangana, and maybe another 600, 700 beds in other states, Maharashtra and Bangalore. Maybe this is the one we are expecting by first quarter of 26, that is 25 January, maybe fourth quarter of 25th. And from there onwards, every 6 months, maybe we'll keep adding another 300 to 400 beds in every 6 months. That's how in 3 years period, we'll be able to add 3,000 beds.
3,000 beds. Okay, got that. Mr. Rao, we'll leave it there. Thank you very much for your time. Good speaking with you, sir. And appreciate you joining us here on CNBC-TV18. Thank you. We'll take a break here. We are back with Arun Maheshwari, Joint Managing Director and Chief Financial Officer at JSW Infrastructure. That's going to be a big IPO, which is opening today, 2,800 crore IPO. So interesting conversation lined up on the other side. Stay with us.
Welcome back. Well, 2023 has been a good year for IPO. So let's focus on one such IPO that's coming up. JSW Infra, well, their 2,800 crore IPO opens today for subscription. They've raised close to around 1,260 crore rupees from a good list of anchor investors. The management, well, they're eyeing debt repayment of around 880 crores, though they also have some capex plans. So to understand more about the business, we're joined by Mr. Arun Maheshwari, the Joint Managing Director and the Chief Executive Officer at the company. Hi, Mr. Maheshwari. Good morning, and thanks so much for joining us here on CNBC-TV18. Well, one point that the street would like to understand is, out of your total cargo volumes, how much comes in from the group company? That's the JSW Group.
Well, as on June 23, the quarter ending June 23, it's about 63% comes from the group company.
Looking at reducing
and 37%
this
comes from outside the group.
Are you looking at reducing this exposure?
Well, it has been, it has been continuously reducing because, way back, the genesis of the company started way back to cater to the group captive cargo. Being a process-driven industry, if you see JSW Steel or JSW Energy, way back when we started in 2004, it was largely for the group captive supply chain management control. Till 2018, we were largely into the group company cargoes, and thereafter we started the focus on the third-party development. If you see very closely, 2019 onwards, majority of our investment has been on the third-party business development. It was as low as 6% in 2019 on a 35 million ton volume. In 2023, ending March, we did about 33% of the third-party volume on a 93 million tons of cargo. So the focus, the intention and investment has been very clearly defined, how we are going to shape up this country as an independent vertical.
Got it. All right. Mr. Maheshwari, I just want to ask you and confirm this. Your margins with your larger listed peer is a little bit lower. You're in the mid-50s or thereabouts. They are in 60%, a little more than that. Is pricing at an arm's length with your group's companies, or is there some kind of pricing difference? And do you expect margins to improve from here on?
Well, I would like to differentiate over here the business model, what we have taken for growth and for growing our business. We are largely, we are 50% into the greenfield ports capacity-wise and 50% from the terminal side. When we talk about terminal are the ports given on PPP model in the major ports, which are governed and controlled by Government of India, wherein the ecosystem is provided by them. And we just pay a royalty against that ecosystem where capex is very low. So instead of looking at the EBITDA percentages, we generally go with the return on capital employed. And I think that's our guiding principle whenever we do an investment. So if you see our total building of capacity of 158 million ton, took a total capital of close to about 7,500 crore rupees, which is quite low as per the industry standard. And that's where because of the part of the EBITDA goes towards the royalty, but the return on capital employed remains very robust in this case.
So what's the royalty amount?
It ranges from terminal to terminal. It is as low as 18% and is as high as 52%. But on an average, if I had to look at for our existing terminals, it is somewhere around close to 27%. And when it comes to arm's length pricing, as was asked earlier, I believe we are a well-governed company. Governance structure is very solid and very well in place for all the companies. So being a listed entity like JSW Steel and Energy, they go through a rigorous process. And since still we were not a listed company, we were behaving like a listed company. And we have been going through the similar process at our end as well. And if I have to give a very flair of, a greenfield port, typically a greenfield port in India makes about 60-65% kind of EBITDA margin. Our two greenfield ports are Dharamtara as well as Jaigarh Port, and they also make similar kind of EBITDA margins. So I think it clearly defines, how arm's length transactions are being handled within the group.
Mr. Maheshwari, hi, good morning. So the distinction is important, right?
Hi, good morning.
So basically, between terminals and ports, ports is high capex and high margins as well, as you said, 60-65%. Terminals is very asset light, but margins are on the lower side as well. And you said you look at return on capital employed as a better kind of metric there to assess profitability. Just a quick point, could you tell us, Mr. Maheshwari, what is the total capacity at? And what will it be? If you can, what will this grow to over the next couple of years? And just trying to get a sense of what's the visibility for additional capacity that the group will look at.
Well, if I to look at today's capacity, it's about 158 million ton. This company is close to about 20-year-old company, and the CAGR on the volume side, if I have to look at it, it has been 22% over the last 20 years. Given the balance sheet what we have, given the appetite what we have, passion and the initiative what the group carries with them for all the verticals, and the opportunity what India offers today in this sector particularly, I think we will be able to try to maintain the similar kind of growth story. Even though the base is very high now, 158 million ton, but our intention is to remain very robust and keep growing on this sector, especially when the opportunities are unlimited over here. Very few players are there in this market today, and because it has a very high entry barrier, the capexes are very high in this sector, and you need a strong balance sheet, and we offer that. And you need to have a good intention to get into this business, and we do possess that.
So, the government is privatizing ports. It's putting up more and more port infrastructure out there for bidding, etc. So there's a large pipeline which will come up for bidding. So you're saying that, so what do you envisage a JSW Infra capacity to be, say, 5 years down the line? Where will you be at?
Oh yes, so the great opportunity which comes from the government terminals, because the government is inviting more and more private players to come mechanize, modernize the existing terminals, because government has done their job in the last 6-7 decades. They have done beautiful ports across the coastline. Now they are inviting people because government feels they should be going into the landlord model policy, and wherein they would be charging the royalty for the infrastructure what they have created, for the ecosystem what they have created. Now, people like us who hold quite a number of terminals in India, we are one of the largest in India on holding the terminals. We understand this business better, and we feel that this is a better way to go ahead, wherein the risks are minimal, the infrastructure is provided by the government, part of the infrastructure, the ecosystem is very robust, the customer base is very defined over there. So it is a very good model to grow from here on. And I think we are well suited for that. The kind of terminals we are already holding, the kind of performance we have exhibited in our existing terminals, and the upcoming which are coming up. It is difficult to put a number on the future from the terminal side because it is a bidding process. You bid for the terminals to win it. You win it, you don't win it, it depends upon that. But then pipeline is superb. Like Government of India still owns about 1,400 million ton of total capacity in India, which is more or less 50% of India's capacity. Imagine that kind of capacity is coming up for bidding, and even part of it comes for bidding in a couple of 5, 7, 10 years. How many players are there in India today for that?
Correct. So you're giving us that outlook that is...
I think we will be able to make it good out of it,
Yes, Mr. Maheshwari, we know that there's huge scope out there. That's the broad point that you're making for a business like yours. A final couple of questions before we let you go. One is, how have volumes shaped up in the first half of this year, if I compare it with last year, point number one. And also the group exposure has come down to 63%. Is that a targeted number that it comes down to further?
I'll take the second question first, looking at the group exposure. The way the group is growing, the kind of ambitions what JSW Steel or Cement or Power has, I think it will be very difficult to reduce significantly the group volume, even though we will continue to grow on the third-party volume. I think on a longer-term basis, it will be remain 50-50 or 60-40 towards the group side. So I think that would be a robust number, even though however best we try. One good thing is that, for any port company, a solid anchor customer is required. What a better combination than that if your anchor customer from your own group and which is growth-oriented. Nothing can be a better combination than for any port company. Now, coming to the volume front, on the H1, we don't have the audited figure. H1 is yet to end now. But quarter one, our numbers has been 25.42 million tons for this June 23, and which is close to about 10% growth quarter-on-quarter basis, if I had to look at it.
Sir, since your focus is on return on capital employed, that ratio has been going up. In FY21, it was 8.1%. FY22, you increased it to 10.88%, and in FY23, it's a 19.49%. Can you increase your ROCE even higher from current levels? Can it go up to, say, 25% based on the business model?
See, ROC is purely a function how the utilization is happening. So our utilization, like June 23 ending, was about 63%. March 23 year end was about 57%. Before that, it was 45% and 35% and on. So as the utilization goes up, the ROC keeps improving, especially when the capex is already done and only the utilization is remaining for performance purpose. If I had to look at, assuming if the company doesn't want to do anything further and just want to retain with this existing asset of 158 million ton, ROC will keep on increasing because the utilization will keep on going up. So, but given the balance sheet, given the appetite and given the opportunity in India, I don't think so we are going to stay here. We'll continue to invest and we'll continue to grow this business. So ROC may get a bit tapered down when we go into the capex model. And when the capexes are high, the ROC will tend to go lower. But as with the utilization goes up, again, the ROC will find its own ground.
Sir, do you have an aspiration in mind? You said the current capacity is 158 million tons. What would the number stand at 5 years down the line?
The way India is growing, I think putting any number to it would be a bit of a challenge as of now. But then I think our ambition is to, remain close to double the numbers in coming years, maybe 5, 7 years or 10 years kind of stuff.
Okay, well, 1,400 million ton capacity, let's assume 50% of it comes into the market for bidding next 5, 7 years. And there are, as you said, you asked the question, how many players are there? There is, what, 2 or 3, right? You and Adani are the largest.
So, maybe pan-India, wherever you see, there are regional players, but then pan-India players are very few.
Yeah, absolutely. Good luck with that issue, sir. It's great speaking with you and hope to speak with you again around the time of the listing. Thank you very much for joining us here on CNBC-TV18 with that perspective. That's JSW Infrastructure with the perspective on the issuance. Well, on to an exclusive conversation now. Latika Chopra, Executive Director of Consumer Research at JP Morgan, is now joining us on the sidelines of the conference they are holding, the India Investor Summit 2023. Latika, good to have you with us here. Thank you for waiting. Before we sort of get into specific sectors or sub-segments in terms of your coverage universe, broadly a comment on consumer demand, which seems to be, at least at the lower end, hurting by all indications. Just your assessment of it briefly before we go any further.
Yeah, sure. Thank you for inviting me to the show. So if I talk about the staples demand, clearly rural has been fairly painful, over much of the last 1 year. And if you look at the Nielsen data, the good news is that we've started to finally see some recovery settling in. After 5 quarters of negative volumes, finally we moved to the positive volume growth zone starting the June quarter. And when we speak to a lot of corporates as well, what we sense is that volume growth at the margin is improving. Of course, a lot of this growth is coming off a low base, but nevertheless, it's some improvement that's underway. And we hope, that this gradual recovery in rural is going to continue. And this is what our base case is also assuming. One of the bigger drivers for this improvement, in our view, is going to be moderating inflation. Product prices have stopped to inflate. Rather than certain pockets, we are actually witnessing deflation, which is allowing consumers to come back and spend. And the other bit is that, FMCG companies themselves are upping the ante on advertising and promotions, further inducing, consumption demand to revive. So we are hopeful that the mass consumption will gradually, improve in the coming quarters. And what we are assuming for our staples pack is also that the volume growth, which is hovering in, flat to low single-digit zone right now, will gradually gravitate upward towards about mid-single-digit plus kind of range in the coming quarters.
Latika, you want to segment the consumer demand in the various categories for, say, FMCG, urban and rural, the paints, jewelry companies, because you do track a couple of these, large jewelry companies. Do you want to talk about consumer durables? Can you segment, the outlook and what you're picking up on the ground in terms of demand for each of those categories?
Sure. So I talked about the rural bit, but just coming to urban, and let me start with the FMCG bit. FMCG demand in urban has been holding out quite well, right? For much of the last year, it's been tracking well ahead of rural, though that gap is now narrowing given the recent uptick that we've seen in rural. But on the discretionary side, the urban discretionary demand has been quite soft. So, you look at QSR, you look at, consumer durables, you look at fashion. These are the segments which have been affected adversely, on account of higher inflation, impacting the disposable incomes.
But at the same time, what we believe is that starting December quarter, there will be some green shoots that are going to emerge. One, the sectors are going to start lapping a low base. And two, of course, the moderating inflation will allow consumers to come out and spend. Now, if you look at the high-end consumption, and jewelry companies, since you mentioned, the organized jewelry players definitely are gaining, market shares from the informal market. Of course, there are a lot of initiatives from their end on product, on distribution, on very attractive offers to consumers, which are allowing them to grow well. And they also kind of target the higher-end consumer, which is probably less affected by the inflationary pressures. So jewelry demand has been good. Paints demand has held out really well, and there the B2B, the real estate, cycle improving. All of those factors have also benefited. Going into December quarter, also we will see the festive demand. This time the peak festive season is a little later, mid-October to mid-November. And we are hoping that this is good. And that's again going to, kind of support the discretionary demand in urban segments as well.
Latika, it's a strange kind of, in a way, dichotomy, right? You've got consumption, which is hurting, but government capex is pretty strong. The point is, if consumption does not pick up, there's no need for industries to put up new capacity, or at least expand significantly. On the other hand, one can argue and say that because all this, infra spending is happening, that will create jobs and boost consumption spending. What's the view at JP Morgan? I mean, between I don't know if you and your infra analysts have that debate, but how do you think about this?
See, for the sectors that I cover, I think companies are here for the long run, right? So, the near term can be volatile. There can be ups and downs on consumption trends. But the broader story is that the Indian consumption story is all about penetration. And then, of course, in FMCG, we talk a lot about premiumization. And to drive penetration, yes, I think companies are adequately investing behind capacity additions, wherever there is a need to be. Over the years, we have seen FMCG companies bringing a lot of, outsourced manufacturing in-house, and they have been investing in building large-scale, manufacturing units to tap into the whole growth potential. So we do not see dearth or, companies really stopping capex, at least for the sectors that we cover. Again, even in durables, we continue to see, companies investing behind adding more capacities, because the view is that medium to long-term growth is pretty much intact in India. India is all about longevity of growth. And the other bit which is interesting that's happening in the consumption space with the market leaders is they're very open to explore, new segments, right? So portfolio diversification is another theme which is at play, for most of the sectors that I cover. And companies are trying to build those medium long-term drivers. So I don't think companies in any way are pulling back on capex in our sector. Of course, they are prudent about, how they spend so that return ratios stay intact. And of course, M&A is another aspect where we have seen, companies willing to put up money, selectively.
Latika, out of time. Thank you very much for joining in. Enjoy your conference. And once again, thank you for joining in. Getting back to the markets, it's still absolutely flat. Keep your eye on L&T. It's seen some buying from the day's low. Today, the large buyback comes to an end. It's a 10,000 crore buyback at a price of 3,200 crore. And today is the last day for that buyback. The stock is off from the session lows. Mitesh is back with us for a few calls. Mitesh, thoughts on the first 45 minutes of trade? You want to give us some trading ideas?
So it's a very subdued kind of a market, and which is not bad. After the decline last week, I think not showing continuation means that there could be some space for a bounce back. Though to me, the texture is slightly on the weaker side, and I would still prefer selling on rallies. But I think there could be a pullback, which could see the Nifty try and attempt levels closer to about 19,750, 770 kind of a range. In the best case scenario, 19,850. So I think, we'll explore some shorting over there. But till then, on the stock side, I have a buy on JK Tires. Keep a stop below levels of 280 here. Look for targets of roughly around 305 to about 308. And the other one is Asian Paints, which is a buy with a stop at about 32.90 and a target of 33.80 on the upside.
Okay, thank you very much for that.
Rima, by the way, Mitesh, if you just stay on, just look at these sugar stocks, Rima. I mean, 5%, 6% on Balrampur. They were not in the mix earlier at all. But Balrampur is up 6%, Renuka is up 4%, Dwarikesh is up 7%. So, you know, it starts with one or two names and then it spreads. Usually it's a sector move when the sugar space starts to move up. So is today one of those days is the question. Any thoughts here? The sugar names, I think you have exposure already in your portfolio as well, Mitesh.
I do, and I think they're showing very good traction. And my sense is that I think these stocks will see good medium-term uptrend. So while they are up today, you would still want to buy them, and because you're looking at more further upsides happening. So, for example, Dwarikesh Sugar, again, it starts with the disclaimer that I have it in my personal portfolio. It's a recommendation to our clients as well. I am looking at a positional target of roughly around 120, 122 to begin with, but good chance that the highest weekly closing of 140 could be tested. Balrampur Chini, I think, had a negative week last time, but it was just a pullback and it's bounced back very strongly from the lower levels. And my sense is that I think, the stock is heading towards levels of 500 plus. So you're looking at least about 10-15% kind of a move happening in the next few weeks. So I'm very positive and buy any declines into these stocks.
Thank you for joining in. Before we slip into a break, here is a special announcement. Did you know that India's cancer burden has witnessed a sharp incline, with 70% of cancer cases being diagnosed at a very late stage? With a vision to reverse this pattern, News 18 Network, Federal Bank, Hormis Memorial Foundation and Tara Trust have come together for a special campaign, Sanjeevani United Against Cancer, dedicated to early cancer detection through regular screening. Watch Sanjeevani United Against Cancer at 8:50 p.m. tonight as we embark on a journey to save lives and promote a healthier future. Welcome back. Shifting our attention to commodities now. Manisha is here with us. Manisha, what are you looking at?
Nima, thank you so much for that. While the ferrous metals seem to be doing quite okay, the non-ferrous metals have seen a continuous decline. Over the last 1 week, we've seen copper, aluminum, nickel, all of those metals decline. And that's exactly how we've seen the Asian markets today open up as well. So the strength in US dollar, which is trading at a 6-month high, definitely has been a deterrent there. And then the markets are looking at the interest rate cycle, which might be higher for longer. That clearly has been bothering the space. You also are looking at Chinese demand uneven. Even as the month of August, the data has been slightly on the positive side, but the property sector is still weak, and we have seen concerning statements come in from there. Markets also are looking at inventories, which have continued to pile up, especially in the months of June, July, and August. September clearly has been on the same lines as well, and that has put pressure. Markets are looking at copper inventories actually gain up by nearly 50% in the month of September. When you look at the inventories from the month of July, we are up by 175%. So we are standing at 162,000 tons at this point in time, which is the highest copper inventories that you have seen since 2021. If you want to buy copper right now, it's cheaper by $64 a ton as versus in 3 months going forward, which is also a highest discount in case of copper cash since 1994. That tells you that currently the supplies are higher and demand not so strong, and that's weighing on as well. This is the inventory picture that we've seen in case of copper. You were standing at a deficit of 72,000 tons in June. July, this number has come down to 19,000. Markets do believe if this is the picture that continues, you could be looking at a break-even or even a smaller surplus coming in case of copper by the next quarter. It's not just copper. Nickel is trading at a 14-month lows. You have seen pressure continue for aluminum as well, which is trading at around 3-week lows as well. Here as well, the markets have seen inventories on the weaker side. Lead inventories, for example, are also trading at the highest since 2021. So markets are actually dealing with higher production from China. Europe seems to be picking up, and inventories on LME are higher because on-ground demand is slightly lower. This is the chart picture where we are looking at aluminum trading below 50 days moving average, above rather, but below 200 days moving average. So currently seems consolidating, but the near-term picture is still on the weaker side. And that's copper for you, which has seen constant decline. It's trading below 50 DMA and 200 days moving average as well. So on charts as well, there's not so much of bullish cues or enthusiasm coming in. This is what we've done on a week-on-week and a month-on-month basis for many of these metal prices. As you can see, on week-on-week, everything has seen a decline. Zinc, barring that, because that saw some gains coming in on Friday. But on a month-on-month basis as well, barring aluminum and zinc, we've seen more pressure come in for copper. So underperformance clearly coming in from Dr. Copper, as we call it. So that really tells you on where we are headed.
Okay, Manisha, thank you very much for that. Get into a break. On the other side is our special segment. It's The Economy, where Lata will get chatting with Shantanu Sengupta, Chief India Economist at Goldman Sachs, and Rajiv Radhakrishnan of SBI Mutual Fund about the impact of India's bonds getting included in the JP Morgan Emerging Market Index on passive and active money flowing into India.